India's FY26 GDP is expected to grow at 7.4%, but the real concern is the nominal GDP growth, which is expected to grow at 8.5%. The budget will give out a growth target for FY27. The nominal GDP is expected to grow at 10%, which is 393.28 lakh crores in terms of value. The other thing which the government is going to do is move to a debt targeting framework, which is basically looking at debt as percentage of GDP growth. In FY26, the provision numbers are expected to be 56.1%, and that should come down in FY27 to 55.2%. Remember, the government is looking at a 50% debt to GDP number by FY31. The next thing is the fiscal deficit number. Now, the fiscal deficit number for FY26 was projected at 4.4%. Now, in FY27, it's expected to come down gradually to 4.3%. The number would be 1.64 lakh crores to watch out for, because that's the number which the street will be looking at. The third thing is going to be the capital expenditure number. Now, that is something which is very important for in the last few years, because capital expenditure is one of the key drivers for growth for the economy. FY26 budget estimated 11.27 lakh crores as capital expenditure. Now, that is expected to come down in FY26 on a provisional basis to 10.58%. Now, the street is expecting that in FY27, the government will put out a capital expenditure number of 11.57 lakh crores. So that is also another big number which is coming out from the budget from a context point of view there. The defense is going to be a big play. We have seen defense stocks moving and rallying on the back of the orders which have come in. The defense outlay for FY26 was expected at 1.92 lakh crores. On a provisional basis, it is again expected to remain the same at 1.92 lakh crores, but FY27, the street is expecting a 20% jump in the defense outlay to 2.3 lakh crores there. The gross tax collection is another number which is going to be a big number to watch out for. In FY26, the number was 4.27 lakh crores. Now, we are falling short by nearly 1.5 to 2.3 lakh crores in FY26 because of the income tax cut, the GST cut. This has led to a fall in the gross tax collection numbers. Now, the street is expecting a 9% growth to 4.27 lakh crores in FY27. Finally, what to watch out for in the budget, because from a budget context point of view, there are a couple of things that the street will be looking at. The first thing would be the PSU asset monetization target. The government has been falling short of the targets which it has been providing in the budget there. So that would be one of the key things to meet, especially with respect to the revenue collection of the government there. The second would be the PSU government control threshold, which is currently at 51%. If the government brings down that threshold to 26% with control, that will be a big boost for many of the PSU bank shares as well. There's also the activity of FIs coming back into PSU banks, because that increases the threshold for them from the current 26% to over 49%. So that is one of the key things to watch out for there. Defense capital outlay is, as I said, is something which is going to be keenly watched out for, given the fact that we are increasing the investment into electronics and hardware, and that growth is expected to be around 20%. If there is a less than 20% growth which that comes in, that would be a key disappointment for the street there. The fourth one would be provision for the 16th Finance Commission and the share to the states. Now, this is something which has been submitted, and the Finance Ministry is expected to provide for in the FY27 budget. And what is the share of the states which will come in as part of the 16th Finance Commission recommendation is something which is very important for many of the states, because the center will be distributing its share of revenue to the state as part of the 16th Finance Commission recommendations there. Number 5 would be the provision for impact of aid pay commission. Now, that's also a thing which is under discussion as and when it comes or it concludes in FY27. The government will have to provide for that in the budget there. So that's something which is important from the PSU employees' point of view, and that also will drive consumption if the pay commission recommendations are adopted from FY27 onwards. The number 6 would be tax swaps and depreciation benefits for data centers. Now, that's a sector which is emerging and expected to have an investment between $25 to $45 billion over the next 5 to 8 years. A lot of investment is been planned there, and the sector is expecting for some of the tax incentives, especially accelerated depreciation for these investments there, and that would be a positive for many of the companies which are looking at data centers going forward. Number 7 would be reduced custom duty slabs from 8 to 5 to 6. There is an expectation that there would be a cleanup of the entire custom duty structure. Rationalization of duties will happen. India is signing a lot of FTAs with many of the countries and trading partners that would need custom duty slabs to be rationalized, and that is something expected in this budget there. Number 8 would be introducing a customs amnesty scheme. That's something many of the indirect tax experts are asking for. That will reduce a lot of litigation, also help in closing many of the cases and garner some revenue for the center there. Number 9 would be withholding tax issue, which has been a lingering issue for foreign investors. Currently, India follows a source-based withholding tax. Globally, as per OECD norms, many of the countries are following residence-based withholding tax, and that's something which is positive for FDIs, private equities who are investing in India, because that withholding tax will help them in having much more clarity with respect to the taxation when they exit investment there. Now, finally, number 10 would be capital gains changes, which is expected. There's not much of hope there, but there is an expectation since we have seen $22 billion of foreign outflows in the last 12 months. There could be some changes to the capital gain structure, and that would help in stemming the entire outflows from the country. So that is the whole budget context. The center is working on a very thin line with respect to fiscal numbers. There isn't any expectation with respect to tax cuts or direct tax cuts which is going to come in here, but it's more about policy structure and ensuring that we stay in the framework of debt management and as well as fiscal management going forward.